Most men come to the market believing the trouble is out there on the tape. They think the market is tricky, deceptive, unfair. I used to think that way myself. But after enough lost money, after enough hours watching prices move without me, I learned the trouble usually isn't the market. It's the trader standing in front of it. And more often than not, that trouble has a name: confusion, strategy confusion, trading without clarity. And trading without clarity fails every single time. You can't fight the market while arguing with yourself. How could you? 1 minute you're bullish because a stock broke out. The next minute you're bearish because someone on the street says it's overbought. Then a bar pulls back and you panic. Wasn't this your idea in the first place? Didn't you plan for a reaction? Or did you just press the button because the market was open and your money felt restless? I've known traders who carried 5 indicators, 3 time frames, and 2 opinions into every trade. They never knew why they were in, and they never knew why they were out. They mistook activity for intelligence. They thought more tools meant more certainty. But tell me, if you don't know what you're waiting for, how will you know when it arrives? The market rewards decisiveness, but only when it's built on understanding. You don't need 100 strategies. You need one that fits the way the market actually moves. Trends develop. They pause. They resume or they fail. That's the business. The tape tells a story, but it doesn't shout. You have to know what you're listening for. Without that, every tick feels important and nothing is clear. I learned long ago that the big money isn't made in the buying or the selling. It's made in the waiting. Waiting requires conviction. Conviction requires clarity. And clarity only comes when you know exactly what kind of trade you are in. Are you trading a trend, or are you gambling on noise? If the price moves against you, is that normal behavior, or is it proof you were wrong from the start? Most losses don't come from bad analysis. They come from abandoning an analysis halfway through. The trader enters with one reason and exits with another. Fear replaces logic. Hope replaces discipline. That doesn't happen when you're clear. It happens when you're confused. And confusion always demands action, even when the best action is none at all. I've sat through more false starts than I care to remember. Breakouts that failed. Patterns that looked perfect and went nowhere. But the difference between a professional loss and a reckless one is simple. The professional knew the risk before he entered. He accepted it. He didn't argue with the market when it showed him he was wrong. He stepped aside intact, ready for the next opportunity. Can you do that if you don't even know why you entered? You see, clarity isn't about being right. It's about knowing what you will do if you're wrong. A man without a plan has no defense. He flinches at every price movement. He watches profits turn into losses because he never defined what a profit was. He listens to opinions because his own ideas aren't firm enough to stand alone. That's not trading. That's hoping with a chart open. Wealth in this business is built the same way positions are built. Slowly, deliberately, with patience. The trader who survives is the one who protects his capital like a businessman, not a gambler. Capital is confidence stored in dollars. Lose it recklessly, and you lose more than money. You lose your ability to think clearly. Isn't it hard to read the tape when you're worried about getting back what you just lost? Every successful trader I've known simplified, not complicated. They stripped their method down until only the essentials remained. Price, time, behavior. They knew what a healthy market looked like. They knew what weakness looked like. And most important, they knew when to stay out. Do you know the conditions under which you do nothing? Confusion often comes from trying to trade every day as if it offers the same opportunity. It doesn't. Markets have seasons. Some days are made for trading, others for observation. If you force trades during dull, choppy conditions, you train yourself to accept poor action. Then when a real move comes, you're already tired, already doubtful. Wouldn't it be better to wait for the market to come to you? The tape never lies, but it often misleads those who stare at it without a plan. A sudden rally means nothing if it lacks follow-through. A sharp drop means little if it finds strong support. Context is everything. Strategy gives you that context. Without it, Every move looks like an opportunity, and every opportunity looks urgent. I've always believed that speculation is a business, and like any business, it demands rules. You wouldn't open a store without knowing what you sell or who your customer is. Yet traders open positions without knowing what kind of move they're after or how long they're willing to wait. Is it any wonder most of them fail? Clarity also shapes your mindset. When you trust your strategy, you don't need excitement. You don't need constant action. You let the market work. You stop proving yourself to the screen, and that calm, that distance, is where good decisions are made. Money is attracted to patience, not desperation. There will always be another trade. There will always be another swing, another breakout, another trend. Missing one doesn't matter. Being confused in one can cost you months. That's a lesson the market teaches repeatedly and expensively. A trader must decide who he is before the opening bell, not after the first loss. Otherwise, the market will decide for him, and it will not be kind. The tape respects preparation. It punishes hesitation born from doubt, and doubt grows fastest where there is no clear plan. A trader without a clear plan is forced to make decisions under pressure, and pressure is the one condition under which the human mind performs worst in speculation. I learned that the hard way. When you sit in front of the tape without knowing exactly what you are waiting for, every movement feels like a command. Prices tick up and you feel late. Prices tick down and you feel wrong. You are no longer reading the market. You are reacting to it. And reaction is never where sound judgment lies. When a man enters a trade without a plan, he is borrowing confidence from the moment. That confidence disappears the instant the market hesitates. A small pullback suddenly feels dangerous. A pause feels like failure. The trader begins asking questions he should have answered before he ever risked $1. Is this normal? Should I hold? Should I get out? Should I add? Those questions come too late. By then, the market is already in control, and the trader is negotiating with fear. Pressure doesn't come from losing money alone. It comes from uncertainty. A planned loss is tolerable. An unplanned one feels personal. If you don't know where you are wrong, you will feel wrong everywhere. That's when traders start watching every tick, shrinking their time horizon, abandoning the very reasoning that put them into the trade. Tell me, how can you judge the importance of a single bar if you never defined the structure you were trading? I've seen men who could read charts beautifully fall apart simply because they didn't decide in advance what kind of trade they were in. They entered a position thinking long-term, but reacted to it short-term. That mismatch creates stress. Stress forces decisions, and forced decisions are almost always poor ones. The market has a way of finding the weak spot in a trader's thinking, and that weak spot is nearly always the absence of a clear plan. A plan doesn't guarantee profits. It guarantees something more important: mental balance. When you know your risk, you don't flinch at ordinary movement. You expect it. You allow the trade room to work because you've already accounted for uncertainty. Without that, every fluctuation feels like a verdict. The trader starts defending himself instead of managing a position. Have you ever noticed how hard it is to stay objective when you feel accused by the tape? Pressure also shortens patience. A trader without clarity wants immediate confirmation. If the market doesn't reward him quickly, he doubts the trade. That doubt leads to early exits, missed moves, and re-entries at worse prices. Over time, this behavior trains the trader to distrust his own judgment. Eventually, he stops following any method at all and begins chasing movement instead. That's not adaptation. That's surrender. The market does not operate on your emotional timetable. It never has. It moves when conditions align, not when you feel ready. A clear plan aligns you with those conditions. It tells you when to act and, just as important, when to sit still. Sitting still under pressure is impossible unless you already know that inaction is part of the strategy. Otherwise, stillness feels like failure. I've always said that the most expensive mistakes are made when trying to avoid small losses. That impulse comes directly from pressure. A trader without a plan doesn't accept losses. He resists them. He holds and hopes, or he cuts and regrets. Both reactions come from the same source: uncertainty. If you don't know the cost of being wrong, you will pay far more than necessary. Pressure also invites outside influence. When a trader isn't anchored to his own reasoning, he listens to others. Tips start to sound attractive, opinions feel reassuring, but borrowed conviction is fragile. The moment the market disagrees, that conviction collapses. A man must trade his own ideas, or he will never trade with confidence. How can you hold a position through adversity if the idea behind it was never fully yours? Clarity transforms pressure into information. Instead of asking, "Why is this happening to me?" the prepared trader asks, "Is this behavior consistent with my premise?" That difference is everything. One question is emotional, the other is analytical. The market respects analysis. It exploits emotion. Wealth in trading is built by surviving periods of uncertainty. Those periods are unavoidable. What separates professionals from amateurs is not prediction, but preparation. The professional expects pressure and neutralizes it with structure. He knows where he is right, where he is wrong, and where he will do nothing at all. The amateur discovers all three in real time, with money on the line. A clear plan also protects time. Indecision is exhausting. Watching every fluctuation drains focus and energy. Over months and years, that fatigue compounds. The trader becomes impulsive, impatient, careless. A structured approach conserves mental capital. It allows the trader to wait without strain, to act without haste, to step aside without regret. Entering a trade without knowing the exit guarantees emotional reactions, because the mind cannot tolerate uncertainty when money is at risk. I learned early that the market has no obligation to explain itself, and when a trader hasn't explained his own intentions beforehand, every price movement feels like an interrogation. You sit there asking the tape questions it will never answer. Should I hold? Should I sell? Is this a pullback or the start of something worse? Those questions don't arise from market complexity. They arise from a missing decision. The exit is not an afterthought. It is the trade. Without it, entry is just a guess dressed up as confidence. A man may tell himself he will see how it acts, but that is only another way of saying he has no plan. Seeing how it acts means reacting, and reacting is emotional by nature. The market moves first, the trader responds second, and the response is shaped by fear or hope depending on the direction of the last tick. Is that really decision-making, or is it surrender? I've watched traders turn good positions into bad experiences simply because they never defined what would prove them wrong. When the price drifted against them, they felt insulted. When it moved in their favor, they felt greedy. The market became personal. That's always dangerous. A trade without a predefined exit becomes a test of character instead of a business transaction. The trader stops managing risk and starts defending his ego. An exit isn't about pessimism. It's about honesty. It forces a man to admit that he can be wrong. That admission is liberating. Once the downside is accepted, the mind is free to observe instead of react. Without that acceptance, every loss feels avoidable and every gain feels temporary. The trader becomes tense, alert in the wrong way, constantly bracing for impact. Have you ever noticed how exhausting it is to hold a position when you don't know what you're willing to lose? Most emotional mistakes happen not at entry, but after entry. That's when reality intrudes. The market begins to test the trade, and the trader has no framework for interpretation. A normal pullback feels catastrophic. A consolidation feels like a trap. Because there is no defined exit, there is no definition of normal behavior. Everything feels abnormal. And when everything feels abnormal, emotion takes control. I've always believed that the market tests a trader's discipline before it rewards his patience. Without an exit plan, there is no discipline to test. The trader improvises, and improvisation under pressure leads to inconsistency. One day he holds too long. The next day he exits too soon. Over time, he stops trusting himself. That loss of trust is far more damaging than any single losing trade. An exit also defines the nature of the trade. Are you trading a swing, or are you trading a position? Are you looking for a measured move, or are you riding a trend? Without answering those questions, you cannot judge whether the market is behaving correctly. You are comparing apples to oranges, reacting to short-term noise while pretending to think long-term. That internal conflict produces anxiety, and anxiety produces mistakes. I've seen traders stare at screens, frozen, because price approached a level they never defined. They hoped it would bounce. They feared it would break. They waited for relief instead of acting with purpose. That hesitation is not caution, it's confusion. And confusion is expensive. The market does not pause to let a trader make up his mind. The exit is also what keeps losses small and manageable. Without it, losses expand quietly while the trader negotiates with himself. He tells stories, he finds reasons, he delays decisions. By the time he acts, the loss has grown large enough to affect his confidence. Now the next trade is taken with hesitation. The one after that with fear. Emotional reactions compound, and the account reflects it. There is a strange comfort in ambiguity for some traders. As long as there is no defined exit, they don't have to be wrong yet. But that comfort is an illusion. The market will decide eventually, and it will decide without regard for the trader's feelings. A predefined exit gives control back to the trader. It says, "If this happens, I am wrong, and I will step aside." That statement removes drama from the process. I always knew my exit before I entered, not because I enjoyed losing, but because I respected the business. No merchant stocks a product without knowing his cost. No trader should enter a position without knowing his risk. The moment you accept the exit, you remove the emotional charge from the trade. The market becomes a series of probabilities, not a personal challenge. Emotional reactions are not a character flaw, they are a structural flaw. Fix the structure, and the emotions quiet down. Define the exit, and the mind stops searching for answers in every tick. The trader can watch the tape with interest instead of fear, with curiosity instead of urgency. That difference changes everything. Without an exit, every trade becomes a cliffhanger. The trader waits for relief, for confirmation, for rescue. He is no longer trading, he is enduring. And endurance is not a strategy. The exit is the boundary between professionalism and impulse. It is the line that keeps speculation from turning into gambling. Without it, emotion fills the vacuum. And once emotion takes over, the market has already won. Clarity allows patience, confusion demands constant action. That single truth explains more blown accounts than any chart pattern ever could. When a trader knows exactly what he is waiting for, time stops being an enemy. The minutes don't feel heavy. The screen doesn't feel loud. Price can move without demanding a response. But when clarity is missing, every moment feels urgent, and urgency is poison in speculation. I've noticed that confused traders are always busy. They trade often, adjust constantly, and explain endlessly. They are doing something all the time, not because opportunity is abundant, but because stillness makes them uncomfortable. When you don't know what conditions you need, inactivity feels like failure. So you manufacture action. You click, you adjust, you jump. Tell me, have you ever taken a trade simply because doing nothing felt worse? Patience is not passive. It is active waiting. It requires a clear picture of what you are waiting for. Without that picture, waiting feels like indecision. The trader begins to doubt himself. Maybe the move already happened. Maybe the setup isn't coming. Maybe today is different. Those thoughts don't come from the market. They come from the absence of a defined plan. Confusion makes traders overestimate the importance of small moves. A few ticks feel like opportunity. A minor pullback feels like danger. Without clarity, the trader's time horizon shrinks. He starts trading 5-minute noise while thinking he's trading a daily trend. That mismatch creates tension, and tension demands release through action. The market does not reward activity. It rewards alignment. When your strategy matches the market's condition, patience is easy. You know that nothing matters until price reaches a certain level, behaves a certain way, confirms a certain idea. Until then, there is nothing to do. That understanding removes temptation. Without it, temptation is everywhere. I've seen traders abandon good positions simply because they were bored. The trade wasn't wrong. It just wasn't moving fast enough to satisfy their nerves. Boredom is another form of confusion. It signals that the trader expected excitement where none was promised. A clear strategy sets expectations. Confusion leaves them undefined, and undefined expectations always lead to disappointment. Constant action is often mistaken for discipline. It isn't. Discipline is restraint. It is the ability to sit on your hands while the market sorts itself out. That ability disappears the moment a trader stops trusting his framework. Without trust, he interferes. He micromanages trades that don't need it. He exits early, re-enters late, and repeats the cycle. Activity increases while results deteriorate. Clarity simplifies decision-making. It narrows the number of valid actions until only one remains, or none at all. Confusion does the opposite. It multiplies choices. Should I buy? Sell. Scale in, scale out, hedge, reverse. Too many options under pressure lead to impulsive decisions, and impulsive decisions are rarely consistent. Patience also protects capital. Fewer trades mean fewer mistakes. Fewer mistakes mean confidence stays intact. But when confusion drives constant action, small losses pile up. Commissions add up. Focus erodes. The trader becomes defensive. Now every trade carries the weight of the last 5. Isn't it harder to wait for the right setup when you're trying to make back what you just lost? The irony is that the market offers far fewer true opportunities than most people think. Big moves require alignment of many factors. They don't happen every hour. A clear trader accepts that. A confused trader fights it. He trades marginal setups and justifies them with hope. Over time, his standards erode. What once looked unacceptable now looks good enough. That's how patience dies. I always found that my best trades came after long periods of inactivity. Not because I was lucky, but because I was selective. I knew what I was waiting for, and I refused to settle. That refusal is impossible without clarity. If you don't know what you want, you'll take whatever shows up. Confusion also feeds the illusion that more trades equal more chances to win. In reality, it increases exposure to randomness. The more you act without a clear edge, the more you hand control to chance. Patience concentrates risk where odds are favorable. Constant action spreads it everywhere. There is a psychological comfort in doing something. It feels productive. It feels engaged. But markets don't pay for effort. They pay for judgment. Judgment requires distance. Distance requires patience. And patience only survives when the trader has confidence in his criteria. When clarity is present, waiting doesn't feel like waiting. It feels like preparation. The trader observes, takes notes, watches behavior, and learns. When confusion is present, waiting feels like falling behind. The trader fears missing out. That fear pushes him into trades he wouldn't take if he were calm. You can always spot confusion by its tempo. Fast entries, fast exits, constant changes, explanations that shift after the fact. Clarity has a slower rhythm. Decisions are spaced out. Actions are deliberate. Losses are accepted without drama. Wins are allowed to develop. Patience is not something you force. It is something that appears naturally when your strategy is clear enough to trust. Remove that clarity, and patience collapses into restlessness. And restlessness always reaches for the mouse. Capital preservation begins with strategic simplicity, and that idea runs against what most new traders believe. They think protection comes from complexity. More indicators, more rules, more adjustments. I learned the opposite. The simpler the strategy, the easier it is to follow under pressure. And the easier it is to follow, the less damage you do to yourself when the market behaves unexpectedly. When a strategy is simple, you know exactly what matters and what doesn't. Price is either doing what you anticipated or it isn't. There's no debate, there's no reinterpretation. That clarity is the first line of defense for capital. Confusion, on the other hand, invites justification. A complicated approach gives you endless ways to explain why a bad trade might still work. That's how small losses turn into large ones. Most capital isn't lost in dramatic collapses. It's bled away through frequent, unnecessary decisions. A trader over-adjusts, over-trades, and overreacts. Each action feels small, even reasonable. But over time, the account tells a different story. Simplicity reduces the number of decisions you have to make, and fewer decisions mean fewer chances to be wrong. I've always believed that risk should be obvious. If you can't point to the exact price level that tells you you're wrong, your strategy is too complex. Complexity hides risk, simplicity exposes it, and exposed risk can be managed. Hidden risk grows quietly, waiting for the moment it can do the most damage. Simple strategies also preserve mental capital. which is just as important as financial capital. When the rules are clear, the mind stays calm. You're not constantly second-guessing. You're not juggling conflicting signals. You're not trying to remember which condition overrides which. That calm allows you to act decisively when action is required and to stand aside when it isn't. A trader who preserves capital stays in the game long enough to learn. Losses are inevitable. Irreversible losses are optional. Strategic simplicity keeps losses proportional. It prevents the trader from compounding mistakes through stubbornness or confusion. When something doesn't work, you see it quickly and step aside. There is also a humility built into simplicity. It admits that the market cannot be controlled, only observed. You are not trying to predict every move. You are waiting for specific behavior and responding when it appears. That attitude naturally limits exposure. You are selective, not ambitious. And selectivity is a form of protection. I've watched traders abandon simple methods because they seemed too boring. They wanted sophistication. They wanted to feel clever. But the market does not pay for cleverness. It pays for consistency. Simple approaches are easier to repeat. They produce fewer surprises. And fewer surprises mean fewer emotional reactions that lead to reckless decisions. Capital preservation also depends on consistency of execution. A complex strategy might look brilliant on paper, but if it can't be executed the same way under stress, it's useless. Simplicity survives stress. When the market moves fast, you don't have time to analyze 10 variables. You need to know instantly whether the trade still fits your criteria. Simplicity also makes review possible. After a trade, you can clearly see what you did right or wrong. That feedback loop is essential for growth. Complex systems blur accountability. Was the loss due to timing, indicator conflict, market conditions, or execution? If you can't answer that, you can't improve. And without improvement, capital slowly erodes. Preserving capital isn't about avoiding losses. It's about controlling the size and frequency of them. Simple strategies naturally limit overexposure. They keep position sizing aligned with clear risk points. They discourage revenge trading because there are fewer excuses to bend the rules. The longer I traded, the more I respected simplicity. It wasn't about being minimal for its own sake. It was about survival. Markets change. Conditions shift. A simple framework adapts more easily because it focuses on fundamentals of behavior rather than fragile combinations of signals. Confusion often masquerades as sophistication. Traders add layers because they don't trust the core idea. But trust is built through experience, not decoration. A strategy you understand deeply is safer than one you barely understand but looks impressive. Capital is the trader's lifeblood. Once it's damaged beyond repair, opportunity becomes irrelevant. Strategic simplicity protects that lifeblood by keeping decisions grounded, risks visible, and actions deliberate. Simplicity doesn't mean easy. It means clear. And clarity is the strongest form of protection a trader can have, because without it, even the best opportunity can become a threat